So we are continuing with our decision problems. This, of course, right now you're doing this on a purely technical basis, and that is because of the urgency of having to do the project. Okay. So now we are talking about entry price. Okay, we have already discussed extensively market order, limit order, stop order. Now everybody understands these different order types. Okay, so don't worry about this numbering here. This numbering is not important. So when we are talking about the decision problems for the management of a risk book, okay, which in this case we are talking about an investment fund, okay, when we are talking about the decision problems, this particular numbering is not so important. It's just the problems themselves are more important, as long as you remember what the problems are. Okay, so this is just common sense. Actually, if you sit and think about it, it's quite obvious. But so the numbering is not so important. It is just there may be some numbering errors in the in what you see in the notes, but the numbering is. We are talking still about how to enter. What is the entry price? The main question that we are talking about is whether the entry price should be at a price. What should be the entry price relative to the current market price? The current market price is obvious to everyone at any point of time, okay, and it's an objective reality. So the question is, when you're talking about entering, are you going to enter at the current market price or at a price more favorable than the current market price? So far we have discussed these two types of orders. Is that clear so far? Okay, but we have not discussed, we did mention this, that if we enter via a stop order, then you would be entering at a price less favorable than the current market price. Do you remember this?
Yes.
Okay, we had the discussion. So market order and limit order, everybody understands by now?
Yes.
Okay, that basic limit order, I hope you're already using this in your trading.
Yes.
Market orders, limit orders, and we have also seen how to add bracket orders. That's a peculiar feature of, but the concept is useful. Okay, that if you want to do easy management of your positions, you add a bracket order. With your limit order, you can add a bracket order. We saw that on the TWS. Now, obviously, every piece of software, TWS is one of the most sophisticated pieces of trading software I've ever seen. So the other software which you might be using may not have all these options, but at least you should know the concept. That's always the reason for using the best possible software. Just like I tell you to focus on the US economy, because the US economy is the most developed economy in the world. So by looking at the US economy, you get to see how what are the features of a developed economy, because many things they have over there which we don't have over here. So if you study only based on the Indian economy, you don't have a full range of you don't understand the full range of possibilities, right? So that's not the correct way to study, especially subjects like finance. Marketing you can study completely based on India, because marketing is very context specific. How you market to a rural Indian housewife is very different from how you market to a Swiss, middle-aged Swiss woman. So it's very different. So marketing is a subject that can be studied purely based on India, but not finance. Okay, are you following what I'm saying here?
Yes.
Okay, so now we are going to get into this odd way of, so why would you enter into why would you buy? So obviously the question is, why would you bother to buy something at a less favorable price than the current market? Either you buy it at the current market or you buy it at the price more favorable than the current, or not buy, transact. Why would you transact? Okay, you understand, transact is more general than buy. Okay, so why would you transact when you're entering the position? Why would you transact at a price less favorable than the current market price? Okay, so to understand this, and the way you would do it, at least understand this initially, that if you are going to enter your trade, okay, at a price less favorable than the current market price, you would be using a stop order. Okay, so let's understand the logic of a stop order. So the market order and limit order we have already understood. Okay, so the thing to understand quickly about the market order is that there is a guarantee of execution, but there is no guarantee of the price at which execution occurs. Okay, this is the basic logic of a market order. You can read, there's a hyperlink also in your notes also. There's a hyperlink for Interactive Brokers. It's a very useful website for learning many things, including order types. You will see that there are almost 40-50 order types, iceberg orders, this, that. So when you're getting into algorithmic trading, when you're trying to combine your knowledge of trading and order types, okay, and how markets function along with your programming skills, if you do a lot of the quant work that gets done in finance is the programming of order types and trading strategies, basically what we call algorithmic trading. Okay, in that you use many of these order types which you see on the Interactive Brokers page. So if you want to learn more than what has been taught in the syllabus, you can go there and learn about order types. Okay, we are only teaching you the very basic order types. Okay. Alright, so the main thing, no guarantee of the price, because you're just telling the market, just sell it now or just buy it now, I don't care what the price is, okay? Just give me my position. Limit orders, obviously, you get a guarantee of execution. Sorry, you don't get a guarantee of execution because, as Garvit pointed out when we looked at that example, that you were placing a limit order to buy below the market, but the possibility exists that the market may never come down to your limit order price. It may just directly start rising, okay? So in which case, therefore, there is no guarantee of execution on a limit order, but there is obviously a guarantee of the price at which the execution occurs. Because the instruction to the system is that I want to buy Apple at, say, $1,500, okay? So if the price currently is at $1,650, then it will wait until it comes to $1,500. Otherwise, it won't buy, okay? So it will guarantee the price, but there is no guarantee of execution. So now we come to stop order. And the best way to understand a stop order is that a stop order, I'll just write it in your notes. A stop order is like, you can think, one way of thinking about the stop order, I don't know if it's mentioned here. Okay, a stop order is like a conditional market order. I think it's a useful way of thinking about it because you already know what a market order is. It's an instruction to the system, okay? And try to think about when you're doing order types, try to think of it in terms of system logic, okay? You have some exposure to programming. Yes. Okay, all the stuff that you do, all the stuff that you've done on spreadsheet software, your Excel courses, okay, understand that Excel is nothing but any spreadsheet software is nothing but a programming environment. Instead of programming in C++, you are programming in that environment of the spreadsheet software, okay? Understand it as a programming environment. And all these formulas that you use in Excel, these are what we call subroutines. You heard this concept before in programming, subroutines? So a subroutine basically is, so you have to think of Excel formulas are like subroutines. Like if you have a formula for IRR, okay, in spreadsheets you have a formula for IRR, what? Everybody's looking blank. You have? Yes. So these are just subroutines. You have a formula for NPV. Yes, sir. So it's a subroutine in programming is basically like a subset of a predefined set of instructions, okay, which has already been programmed as a set of instructions, okay. So and that set of instructions has been called IRR. So whenever you call that by writing that syntax IRR, this is all syntax, okay. You understand when you're doing this stuff on your spreadsheet, okay. When you're doing this stuff here, you're actually using this as syntax, okay. So when at the moment I write IRR, so spreadsheet knows what I'm writing. Here if I started writing INT, RR, it would not understand because the syntax is wrong. So you have to understand these terms because as modern students you have to be very, very tech savvy. So you have to have a good understanding of, you may not be a top-notch programmer, but you have a good understanding of how programs work, how software works. So these terms you should understand. Like I found out you didn't know about the records and fields in a database. Okay, so these kinds of basic concepts you must have. Okay, so these are basically, this is called syntax. So the right syntax for getting internal rate of return results in a spreadsheet is IRR. You can't write INTRR. That's wrong syntax, so the system will not understand it. Okay, so but this is actually what is called a subroutine technically in a programming context. It's a subroutine because so spreadsheet software, whether you're using Excel, here I'm not even using Excel, I'm using Google Sheets, right? Okay, so the system already knows that when this person is using this syntax of IRR, it wants me to do a certain set of calculations, certain specific calculations, which I will not do if the user is asking me to do sum. If I write SUM sum, that means the thing is asking for a different set of instructions. IRR is a particular well-defined set of instructions, right? Okay, like get me a cup of coffee to a robot is a different set of instructions than go and photocopy these 5 pages, right? Are you following what I'm saying? So you have to, everything has a syntax, and the system wants you to talk in the language of the system, which is called the syntax. So if you use the right syntax, then the system will respond. Okay, so that's what we mean. So all of these, so understand spreadsheet software is just nothing but a programming environment. Okay, so you're writing programs in this particular environment, you have to follow the syntax of this particular environment. So what I'm talking about, why did we get into this long, and now you learn some new things, concepts like syntax, the fact that spreadsheets are actually a programming environment. Okay, just like you're instead of programming in C++, you're doing this in a spreadsheet software. So So syntax you've learned, okay, you've learned the concept of subroutine also. A subroutine is nothing, all these Excel formulae are all subroutine. Again, I should not be saying Excel, I should be saying spreadsheet software, but Excel is a shorter word. Okay, so these are all basically subroutines, so you should know this concept also, which means it's a specific set of instructions. Make me a black coffee. To the robot, it's a specific set of instructions rather than make me a proper coffee with milk and sugar. Okay, so when you say make me a black coffee, the robot will execute that specific set of steps. So similarly, when you're calling for IRR, it's a subroutine, it will execute those specific set of steps only. Okay, so that's why, so it's subroutine because it's like a, you can just call it with a particular syntax, okay, and it will execute that routine. So you put it in, it is sub because normally it is put under, it is nested under a lot of other instructions, okay, like do this, perform a project analysis. So maybe the larger program is to perform the project evaluation. Under that, one of the jobs is do the IRR. Okay, so that's why it's called a subroutine. You just put it into the larger set of instructions. Okay, so you learned some new concepts today. Okay, so the system logic, to understand system logic. How does the system think? How does the computer understand the instructions? So it's very important for you to be thinking along those lines because you have to get used to thinking like a like you're talking to a computer. This is clear? So subroutine and some other stuff you learned. Okay. Syntax and some of the other terms that you learned. Okay, so if we go back to this one itself, I have written it in here. Yeah, so I am calling the stop order a conditional market order because I'm teaching you a new type of order, which is you already understand the market order, so it's easier to understand it in relation to a market order. A market order is an instruction to the system, just sell or buy it right now. I don't care what the price is. Okay. But a conditional market order means it is not going to be transmitted until a certain condition is fulfilled. Is that clear? Okay, that's what a conditional market order means. So essentially that means once a certain condition is fulfilled, the system will transmit a market order. Okay, so that's what a stop order is. So you notice that a stop order has, we have talked about parameters, yeah. So we are saying that, remember at the beginning we said something about this part here, that when we talk about parameters, we are not talking about time in force, amount, destination. Okay, destination is whether you want to send the order to the BSE or the NSE or the New York Stock Exchange or the Philadelphia Stock Exchange. You can, in advanced software types, you can actually give that instruction also. All right, so those things we don't include in number of parameters. This is not so important, number of parameters, but just to understand the concept that market order, we say there are no parameters. In a market order, therefore, there are no parameters because as soon as you enter a market order, okay, whether it's a buy or a sell, the system understands that what it has to do. Okay, that's why we say in a market order there are no parameters, and therefore, in comparison, in a limit order, there is one parameter. Is that clear? There's one parameter because the limit price, because you're telling the system to buy it at a design as a designated price, so that you have to tell the system the limit price. Okay, so that's why you'll notice when you're entering orders on TWS, market order, it doesn't ask you for anything. Okay, because if you click on the bid, it knows you want to sell. If you clicked on the offer, it knows you want to buy, and then you enter a market order and it immediately transmits. Okay, with some, you have to override some of those pop-ups. Okay, but in a limit order, it will ask you for the limit price. What is that price at which you want to buy, okay, or sell? Okay, so it's got one parameter. Okay, so in a stop order, basically also the parameter is 1. Okay, there's only one parameter in a stop order, which is basically, in this case, you have to give the stop trigger level. You're already familiar with this. Okay, so I'm just rehashing this once again because you're already familiar that when you enter a stop order, we have discussed all these extensive cases of where we are looking at our TCS. We took the example of TCS as a kind of like a case study, like a running case study. And yeah, okay, so we took that and we talked about all kinds of stops. We talked about stops over here. Okay, we talked about stops over here. Okay, all these discussions when we are talking about position sizing and all that. Okay, all right, so so therefore you're already familiar with stops. So stops have only one one parameter, because you need to enter the stop trigger level, which was here, which was here. These are the stop trigger levels that we have to enter. Okay, all right, now the question is, okay, now we are going to talk about why would you enter a position at a price why would you enter a price why would you enter the position or a trade at a price less favorable than the current market price? Okay, and the way you would do that is by using a stop order. But the question is that it sounds kind of stupid. Okay, why would you do that? Okay, the reason you do that is there is a logic of something called a breakout trading system. Okay, we can put this here actually, that put this in discussions for today. We are having a discussion on breakout trading systems, how to enter the reason we get into this topic is this, why we are trying to understand why we would enter a position at enter a trade at a price less favorable than the current market price. So the reason you do that is there's a category of systems called breakout trading systems. So the logic here, maybe first we just read it a little bit. So it becomes bullish when a new high is made. Okay, and I'm only going to highlight this because the reverse obviously applies. Okay, and becomes bearish when a new low is made. So essentially what we are saying is go back to the try to understand the logic of a breakout system, which is that let's look at this. Okay, now suppose that these highs, they're in fact not the same. Okay, but suppose that these highs were all the same. So this actually is higher than this high. Okay, but for the sake of our argument, for the purpose, because you're never going to get exactly the same highs. Okay, so for the sake of our argument, we will assume that these highs are all the same. Let's say this one, this one, this one, this one, and this one. We are going to just forcibly assume that all of these highs are the same. Okay, so essentially what you're looking at is if you make this a slightly longer time frame. Okay, if we make it 240, and we'll be able to see. All right, so you're looking at a long uptrend in TCS. Okay, so what we are saying is that these highs, this one, this one, this one, and the last two that you see there, okay, these two, okay, all are the same. All right, so now if you, obviously the question that arises is that, so you can already see the long uptrend. Okay, but this is the highest high that has been made because all these other highs are all the same as this level. Okay, so far we can say mathematically this is the highest level that the market has reached. Okay, and tested it many times, but after this there has been no higher high, because we are saying all the other highs are equal to the other high. Okay, so one of the questions that you could have is that you may have noticed when you're looking at business television, when the market is going up, most of the discussion is, oh my god, is it a top, is the market going to drop now, are we near a top? Okay, so that the media likes to play that game. Okay, so the question is, you might have that same question in your mind, that is the uptrend over? Maybe the uptrend is over because we haven't made a new high and we are repeatedly failing at the previous high. Okay, we are repeatedly failing to cross, because if you just hit equal to and then come back, that means you're failing to cross. Okay, so therefore that question might arise. So then obviously what will happen is that once the market makes a new high above this high, okay, which is all these new highs, once it breaks above this this particular high, then it would have confirmed the continuation of the uptrend. Is that clear to everyone? It would have confirmed the continuation of the uptrend. So therefore, basically, for those who want to be a little more extra conservative, okay, or those who want to take their views in this particular manner, okay, they would say that, okay, I don't really have a clear view right now, because it's possible that the market, it's a long uptrend, the uptrend might have stopped over here, okay. But if the market actually makes a new high, then that's a confirmation that the uptrend is continuing. Is that clear to everyone? Why is it a confirmation that the uptrend is continuing? New highs, you have to, higher highs and higher lows. You have to be more specific than that. Okay, so that is the right answer. That means it continues the pattern of higher highs and higher lows. Okay, this is the major low that you see after this high is formed, and this low was never exceeded. I think this is the actual low. Okay, and this low was never exceeded. Okay, on the downside. So therefore, the whatever low was formed over here, all these lows, they are all higher than this low, and then you go and break above this high, and you continue continue the pattern of higher highs and higher lows. That's why at this point making a new high basically confirms the continuation of the uptrend. So for that may be important for those who are not so confident that the uptrend is going to continue. Okay, so is that clear to everyone? That's clear. Okay, so therefore this is what the logic of a breakout trading system is. A breakout trading system looks at this kind of a range. Okay, so you can see this is the contracting range. People would call this, when you're looking at technical analysis patterns, you can use this. Stock Charts has I don't know if there's a free login or something, you can try that. But these, if you want to learn a little bit about technical analysis and chart patterns, these guys are good, because there's a lot of stuff on the internet which is not very good. Okay, so I would suggest that if you want to learn about technical analysis in chart patterns, you learn from here. Okay, so I'm putting this link into your session outline. Okay, so I'm just putting it here. Okay, it's kind of random, out of off topic, but you'll understand. Okay, you just need to have the link. All right. Okay, so that's why you can see, so when you look at these patterns, there are many technical patterns. So technical analysis, as I said, is a vast subject. You can actually have 3 courses on technical analysis alone. Okay, like what we do here in terms of our 3 electives, we can actually have them all on technical analysis. And so there's one of the categories of technical patterns, technical tools that we use is chart patterns. So classical chart patterns. So you might have heard of these terms called, this would be called an ascending triangle. Okay, so this would be called an ascending triangle, where essentially it would be a continuation pattern, and so therefore after this the market is likely to go up, because you can see it's like kind of pressing up, okay, and then eventually it breaks out. So the logic of a breakout trading system, the person who uses a breakout trading system, the logic is they're waiting for confirmation. Okay, they're waiting for confirmation. As soon as it makes a new high, that is a further confirmation of pattern of higher highs, higher lows continuing. Therefore the uptrend is still intact, so now we can buy. This is clear? So that's why, okay, so now you can see obviously that, so therefore what is the guy, if we zoom in a little bit more, okay, we can see it closely. We can, let's assume that this price is 2300, just for the sake of argument we want to use a round number. Okay, so let's assume that this price of 2300 is where it's been failing repeatedly, once, twice, third time, fourth time, fifth time. Okay, so now let's say the market drops a little bit more to about this level. It's almost at the highs right now, so obviously this looks also like it's going to break out. Okay, but let's say it comes back a little bit to say about 2212, okay, or 2218 or whatever, 2220. Okay, so now the market is at 2220, let's say. Okay, so what the breakout trader is going to do is, so what is the logic of the breakout trader, what is the thinking of the breakout trader? That at this point of time I don't have a view, because I'm not sure whether the uptrend is over or not. Okay, but if the market goes above 2300, then I have a view, then I'm bullish. Are you following the logic of the breakout trader? That he will become bullish. At this point he has no view, but he will become bullish if the market goes over 2300, okay, which is the highest high so far. Is everyone clear about this logic? Okay, so you are clear the logic? Okay, so if that's so, then if you become bullish above 2300, then what should you do in terms of your action? Buy or sell? Yes, people are not getting confident answers here. Shreya is murmuring, but she's not giving the right answer. Yeah, she's not. What is the answer? Let's hear your answer. Is my question clear? If I am a breakout trader and I become bullish as far as my view is concerned, I become bullish on TCS when the market clears 2300, okay, goes above 2300, then what should be my action? Buy? Is that clear? Obviously I'm not going to sell if I suddenly become bullish because right now my view is neutral. My view right now is neutral, so I have no position. So the other thing that you have to be clear about is, you'll see that technical trading can be done in a very logical way and in a very precise way. Okay, so it has to be very logical. So if I don't have a view at this point of time, then I shouldn't have a position. Is that clear? I shouldn't have a position if I don't have a view. But the moment I become bullish, I should have a position, and that should be a long position. Is everyone clear? Okay, so therefore at this point already the breakout trader knows when the market is at 2220. Okay, when the market is at 2220, the breakout trader already knows that if the market goes at above 2300, I will become bullish, and therefore I will want to buy. Is that clear? Okay, So if you want to buy when the market is at 2220 and you want to buy when the market rises above 2300, so which means our trigger is going to be 2301. Let's assume that the minimum increment is 1 rupee, okay, for the sake of argument. In this case, it will be 2300.25, okay, because we are trading in 25. So 2300.25. The moment we see the market trading at 2300.25, which means 2300 has been broken. Clear? Okay, so that means now the breakout trader is bullish and so he wants to buy. So 2300.25 is his trigger. Okay, so but the market right now is at 2220. So he knows that if the market goes to 2300.25, he wants to buy. But right now the market is at 2220. So that means he wants to buy at a price higher than the current market. Is that clear?
So why would he want to buy if the market is good now?
Because he's a breakout trader right now, he doesn't have a view. That's why I explained the logic of the breakout trader earlier. Are you following the logic of the breakout trader? Okay, let's launch it once again. Let's understand that. So that means that the earlier step itself we should have stopped. Okay, when I was explaining the logic of the breakout trader. Okay, now we can see the ascending triangle in great detail. Okay. All right. Are you following this so far? That the market has been stopping here. We made this kind of crude assumption here that these highs are all the same. So it's stopping at 2300 repeatedly. It's failing there repeatedly. So this guy is not sure. He's a breakout trader. He's not really sure. Maybe at this point of time when the market, and we assume further that the market has dropped to 2220. Okay. Okay, so the market has dropped to 2220. Actually, it's around 2247. But right now, we assume that the market has dropped to 2220, and the highest high so far is 2300. So he's not sure right now whether this uptrend is over or not. Okay, but obviously, if the market, as Chug has explained, if the market goes up about 2300, then it would have re-established a pattern of higher highs and higher lows. Okay. And I mean that is most recently re-established it. Okay, so therefore that would have confirmed that the uptrend is still in progress. Is that clear? So that means if the uptrend is still in progress, this guy, breakout trader, basically wants to buy when the trend is up. Okay, he wants to sell when the trend is down. So that maybe that is confusing you because I didn't mention that part. So maybe I should have mentioned that, but we have to talk about something else before we do that. But anyway, so the breakout trader's idea is that he wants to buy when the trend is up and he wants to sell when the trend is down. Okay, that is another logic. We are going to come up with terms for this. Okay. But so it's a good question because is that the one that confused? Is that the part that confused you?
Yes.
Okay, so you didn't understand, yeah. So I should have given that logic further before explaining the breakout trading logic. Okay, so the other philosophy of the breakout trader is that when he looks at a long-term uptrend, if the trend is still up, he wants to buy. Okay, if the trend is still down, he wants to sell. He wants to go with the trend. Okay, so he's a trend follower. So what we should do here is we should talk about okay. All right. Okay, so we are going back to this concept of, let's just pause here and go back to this concept of momentum versus mean reversion. So I put these two terms here, okay, trend following or momentum and contrarian or mean reversion. Okay, so we use momentum versus mean reversion. These are important terms that the market will use, and these are very important concepts also because you can apply it even to fundamental analysis approaches. Okay, so it's important to understand this. These are just two names. Okay, so it's just like saying that, you know, either you say momentum versus mean reversion, which is like in English you're saying Indians and Japanese. Okay, and then if you say it in Hindi, you would say Bharatiya ya Japani, right? So in that case, you're saying trend following versus contrarian. Okay, so these are the same things, basically two different ways of saying it. Okay, so momentum versus mean reversion is a more commonly used set of terms. So let's understand what these two terms mean. Okay, so essentially what this means is, this is actually important also. You should do an experiment with yourself to try and understand what let's try and see this. All right. Okay. So when you look at a long-term chart, typically you will see, even on any short-term chart, you will see a trend. Okay. Most of the time, If you're not seeing a trend, you just have to zoom out. Eventually you'll see a trend. Sometimes it may be consolidating in the short run, but so there's a trend here. Okay, so what the momentum trader does, okay, so we have more momentum type of traders and we have mean reversion type of traders. Okay, this is like vegetarians and non-vegetarians. Okay, so typically a vegetarian obviously will not eat non-veg. Okay, so this is kind of like a slant or a philosophy or something like that. Okay, so once you find that you're actually a trader who believes in mean reversion, you will find that whatever market you're trading, whether it's a currency market or the commodity market or equities or debt, okay, whatever you trade, you will have a mean reversion approach. And typically everybody is aligned one way or the other. It's like some people those who bat left-handed will, when they are playing tennis, will also probably be playing tennis left-handed. Okay, so that is the point I'm trying to establish here. Okay, so either you'll be a momentum trader or you'll be a mean reversion trader. It's very unlikely that you will switch your philosophies between when you are changing between markets. Okay, so let's understand what these mean. So a momentum trader essentially is going with the trend. That's why the other name of momentum is trend following. Okay, trend following, you understand? You're following the trend. Okay, so therefore the momentum trader basically tries to go with the trend. So there may be two types of momentum traders. Okay, which is either you are somebody who looks at any given trend. Here you can see clearly on this particular view, it's clearly the trend is up. Okay, so in this case the momentum trader would just assume that the trend is up and it would immediately go long straight away. Okay, so if you're looking at these very large swings in the price, if that's your zoom level that you're applying, okay, every zoom level is like a different system. Okay, it's like a different trading system. You have to think of every zoom level as a different trading system. So if this is the kind of longer term trading system you're using, that you're looking at this high and then this low, high, low, high, low, and then this seems to be going very close to this high. So the momentum trader in this case, who is following this degree of system, will straight away go long at market, because we are assuming that in this case we are back to that system of where, to simplify matters, we are going to always assume that we enter at market. Okay, and of course we'll change that when we come to the breakout trader. But so one type of momentum trader will be a person who automatically assumes, by looking at the trend, that the current trend is still in progress. He assumes that the trend is not over. Okay, so you can have essentially, so I'll write this once again in your notes. Okay, so momentum traders may either assume that is still in progress. So let's understand this category. And there's a very important saying in the markets actually, which you should be aware of. This is called the trend will. This is very popular among trend following traders. The trend will continue until it ends. It's kind of tautological, obviously, that the trend will continue. I will live until I die. So it is kind of it's like that. But the point is trying to emphasize here is that until you see the message of this particular maxim it's an important message actually for if you want to be a momentum trader, is that on this chart, do you see any sign of a trend reversal? Do you see any sign? There's no sign. If you are following these big trends, okay, if I force you to follow only these big swings here, one high here, then low, high, low, and then another high here, low here, and then going very close to that high. So if I force you to follow only at this level of the zoom, okay, then do you see any reversal? Is there any sign of a trend reversal? the bullish trend is still in place, right? Because you have a pattern of higher highs. You had this high, now you have a next high which is higher, okay? Then you had this low, the next low is lower, but typically, ideally here at this point to establish this as a low, we have to go above this high, okay? But you can see even this low is higher than even this low, okay? Even this was not broken, and obviously it's higher than these other lows from where this is coming. So it's a long uptrend, no sign of reversal. Can you see that? So basically that's what the message of that particular maxim is, very important maxim, which you should remember if you want to be a momentum trader, is that the trend will continue until it ends, which means that if you can't see any sign of a trend reversal, then you assume that the trend is going to continue, okay? That the trend is still in progress and it will continue because you have not seen any sign, so the trend will continue until it ends. So you wait for the market to give you a sign of the ending of the trend by breaking below, in this case of an uptrend, by breaking below a previous higher low, breaking below the highest low so far. In this case, the highest low so far is very close to breaking out here. So you can just assume that this is the highest low, right? So at this point, if it breaks below this, only then you know that there is a reversal. Otherwise, there is no reversal. So what these guys do is that this category of momentum trader will basically just assume that the uptrend is in place and straight away they'll want to buy. Okay, and in this case we want to just simplify this as an entry price assumption, and we assume that they are going to buy at market, and then the stop, and on this degree of system the stop will be here. If you're using a shorter degree of system, a much smaller system, you can see that this high, what is the high here? What is the high here, guys? 2281. Can you read it? What? I am positioning the cursor on the high. I am positioning it deliberately here. Why should I go above? You have to read the stuff on top. Don't follow this stuff on the right. You read the stuff on the top. That's how you read the values from a chart. Okay? Which is important if you're a technical trader because you're going to be setting your stops. Okay? So 2281, everyone is clear? This is also something to learn how to read the chart. Okay? Now this is higher, I think, based on my assessment. Is that correct? Is that correct? So visually, because I'm so used to looking at charts, just by looking at it I can see that it is higher, okay, because my eye has got used to it. So it is just 1 rupee higher, 2282, okay, so it is already higher. So now what can I do if I'm a shorter term trader? Remember, this is the other stop. From a long term trader, if for the long term system, this will be the stop, or let's say this is the actual low, this is the stop, okay. But if I want to use, but that's very far away from this current level of 2252, okay, and this one around 1776, it's a very long distance, which means my position size will have to be much smaller, okay. But I can use another tighter stop because this is higher than this. Can you see that? We already showed you that this is higher than this by 1 rupee. That's good enough for me. Minimum tick size, 1 tick is higher, good enough for me. So I can use this stop also, because actually on the shorter term patterns I have a low, high, low, higher high. So I have a low, I have a higher low, I have a high, and I have a higher high. I've got my uptrend, clear? Okay, so I can immediately buy at the current market, and where will my stop be? Here, because the trend will continue until it ends, and if it goes below this at this point of time, it would have ended the trend, because the pattern of higher lows would have been broken. Is everyone clear? You're following? Okay, so therefore the other option is for me to, for a short term system, I can just put the stop here. Then you can see it's a much tighter stop, so I can afford to use I can take a much bigger position because the stop is much tighter, okay, with the same risk limits. Okay, so the first thing we are learning is that basically a momentum trader will straight away go long because he doesn't see any reversal of the trend, so he assumes that the trend is still in progress, and therefore he straight away goes long under these simplifying assumptions. He could have also used a limit order, but we are going to just do away with that complication for now. We'll assume he goes long at market and he places a stop either short term system over there or long term system over here, and that's it. Decision is taken. Clear? Okay, you see how simple it is. Okay, technical analysis. Okay, now the other category of momentum trader is essentially the breakout systems trader. Okay, which is, if we go into your notes, okay, so either assume that the current trend is still in progress, the trend will continue, and which is the first category. Okay, or B, what we call so we call these people who use breakout trading systems, we call them breakout traders. Okay, in which case they need a confirmation Is this part clear? This is already in your notes anyway, right? That the second category of momentum trader is a breakout trader, because they also want to go with the trend, but they just want to assume that the trend is essentially that the trend is they want to look for a confirmation of the trend by making a new high. Okay, is this clear? Okay. Now, so that's why now is it better, more clear to you that if we say that breakout traders want to go with the trend, okay, so therefore they want to buy when there's a new high. Okay, so we were coming back to the idea of using the stop to enter the position, okay, which is that if we go back here, we're going to use a stop to enter the position. So right now, even if we take the current market, if the current market is 2250, okay, and we are saying that if the market goes above 2300, then we want to buy. Okay, so if that is the case, in that case, then you want to buy, you want to place a buy order at a level which is higher than the current market. Is that part clear?
Yes, sir.
Right? If you're a breakout trader, you want to place a buy order at a level higher than the current market. We have shown you the current market is 2250, right? And the trigger level for you is 2300. So above 2300, you want to place a buy order. This is clear? Are you following?
Yes.
So therefore that order must be a stop order. Because remember, what is the property of a stop order? A stop order always transacts at a price. The stop order is kind of like opposite of a limit order. The limit order will transact at a price more favorable than the current market. We don't want to be using loaded language like buy, sell. We want to use general language like yeah. So the stop order will always transact at a price less favorable than the current market. Is that clear? Okay, so limit order, another way to remember the stop order, one is that it's a conditional market order and the other is it's kind of like opposite of a limit order. Okay, so always transact at a price less than the current, less favorable than the current market. So in this case, you have to think about it visually, okay, with a few of the concepts that a breakout trader essentially is going with the trend, okay, whatever is the trend established, okay. So this by going and making a new high, so the breakout trader almost has, I mean, at this point, therefore he's neutral. That's why he's not buying anything or doing anything or selling anything right now. He has no view. Okay, so but when the market makes a new high, he sees that the previous pattern was also of higher highs and higher lows. So he's saying that the market is confirming the continuation of an uptrend. So therefore I want to buy because I'm a momentum trader. So I want to go with the trend because the trend seems to be up still. Are you following? Chugga is not convinced. Are you convinced?
I am convinced what the concept is. I think it is stupid. I still think it is stupid.
Don't worry about it, stupid. You can think it's stupid, which means probably a mean reversion trader, which will come to now. Okay, but so that's okay. Don't worry. But first you try to understand the concept. Okay. All right. Okay. So so is this clear to everybody so far? So that's why now you understand why somebody would use a stop order to enter a position, because the stop order would take him into the position at a price less favorable than the current market. Because at the current market price, he has to, obviously the logical way for, if you tell the computer will say, why not just buy at the current market then? If you want to buy at a higher price, higher than the current market. But at the current market, the trader does not have a view. Are you following?
Yes.
Because the breakout trader is waiting for confirmation. So he doesn't have a view at the current market. That's why he has no position at the current. He can't buy at the current market, because unless you have a view, you can't buy or sell, right? Are you following the logic? Okay. All right. So that's why. So now you see the first example of why somebody would use what we are showing you here, that you buy at a price worse than the current market. This logic, right? Coming back to this logic, right? That now you understand why this would happen, that somebody would enter a position at a price less favorable than the current market, okay, by using a stop order, because they are essentially a breakout trader. They are looking for confirmation of the trend before they enter a position, so they are not sure about the view at this point, okay. Garvit has also gone out, right? Both of you are, what, you don't know, but you can see Garvit is not here. So where is Garvit? Call him, bring him back. Okay, okay. So so are you following this now? Why did we write this? That you enter positions, you can also enter positions at a price less favorable than the current market. Now you understand this counterintuitive logic concept, right? So so that's what the momentum. That's what the breakout trading system does. And so the breakout trading system, if you want to apply it in a pure way, you would apply it actually. Alright, so essentially what it would do, it would typically, it's better to apply it on a longer term system, okay, because the short term there's a lot of noise. But essentially what a breakout trader is, that if there is a new, after going to a new high above 2300, let's say, then if the market goes to a new low, if the market makes a new lower low, okay, when there's a new low, okay, let's try and understand this one system which we have here, which is the Donchian trading system, okay. So now we're going to understand, you have a link to the Donchian system, which you will see here. This is called this is the name of a guy called Richard Donchian. You can read it here, what the system is. It's a 4-week trading rule, which is this is a historical system, so we are just trying to understand it. But 4 weeks is just a general, 4 weeks is just a specific value that has been set. But in general, you can think of it as a new high or a new low. Okay, that's why I've written that a breakout trading system essentially, okay, becomes bullish when a new end period high. Why have I used end period? Because here n has been replaced by, in the Donchian system, n has been replaced by 4. I mean, n is equal to 4 in the Donchian system, and period is equal to week. Okay, that means your granularity is weekly. You understand? You are recapping some of those concepts. Granularity. When you go to the chart and you want to go for your, this is right now the granularity is 4 hours, but if I want, I can go for 1 week. Okay, so that will change the granularity to 1 week. Okay, and then the Donchian, if you want to understand the Donchian system, we can write it here. There's not that much data. Oh, we still have that lot of data here, even on, but let's try to understand Donchian here. Okay, so are you following? So you should follow both. You should understand the general language that I've used, and then I've taken the Donchian system as a specific example because it's a very famous system. It's the most famous breakout system in technical analysis. Okay, so it was used in the commodity markets, but you can pretty much apply it everywhere. Okay, so but understand this. You should be able to You should be able to transition easily between the general and the particular. Okay, so that's why you notice my definition of a breakout system is a system which becomes bullish when a new end period high is made, and it becomes bearish when a new end period low is made. Okay, now this is the general statement of the thing, and then the Donchian system is a specific case of a breakout system. So here n is equal to 4 and period is equal to week. Period could have also been 4 hours, could have been 1 hour, could have been 5 minutes. There's nothing stopping you from making it a 5-minute period. okay, and N can be set to 20, or you want to trade it to 12. That means every hour you have if you're looking for a breakout for a new hourly high. So it can be, so you should understand the possibilities, okay, that it's given as an N period. So N, in the case of the Donchian system, N is equal to 4 and period is equal to week. So period will refer to the granularity of the chart. Are you following? Okay. So in this case, we are specifically to illustrate the Donchian system, we are looking at TCS on a weekly basis. All right. So we can see now essentially that you can take this as the current week, okay, or you can take the previous 4 weeks, okay. So this is it's better to take the previous 4 weeks. So in this case, what we see is that here's your last week before that, and before that. So what is the highest high so far in the last 4 weeks over here? 2281, okay, and as we saw, it's already broken. 2282. So the high of the last 4 weeks is broken. So even under the Donchian rule, you can see that technically you have a buy signal. This is what we call a buy signal. Okay, you have to think in terms of technical trading systems logic. Okay, so it's a very vast field. So you better make, and this is a very useful field. You can actually, as I showed you, with good risk management, it's a very objective, very simple kind of approach. Okay, you can comfortably thrive in the markets with this kind of an approach. Okay, no, the market, if your risk management is solid, the market can never do anything to you. Okay, so it's a completely legitimate approach. So it's a useful thing to try and understand and master all these concepts. So the entire thing, then eventually it will go into algorithmic trading, where you can bring in your programming knowledge. Once you understand the theory of technical analysis properly, understand what you're trying to do, that programming is just it's just a way of automating what you want to do. Okay, it's just like, instead of every day I have to make coffee, I write a program and create a robot to make my coffee. Okay, so I don't have to do it anymore, because it's making coffee, then you don't have a new recipe every day. So it's the same old thing, right? So I just write a program and a robot does that for me. That's all that algorithmic trading is. So you decide that certain things can repetitive tasks that are much better done by a computer, you just program it. Okay, so all that goes into algorithmic trading, but there's a vast body of theory and technical analysis which you can learn, some of which you can learn from that chart school link I gave you. So, and this is one example of that. So the Donchian trading system is one example of that, and you can see here you have a buy signal in TCS. You can see directly how it will work. Okay, so here you would go along straight away at the market. As soon as it goes to a new high, 2282, the moment it goes to 2281.25, in this case of TCS, you would have gone long under the Donchian system. Okay, because every week your system starts out by monitoring the high and low of the last 4 weeks. Okay, so here automatically you can see that it has gone long at 2281.25. Okay, and where will the stop be? The stop will be at remember what the logic says? Bearish when a new N period low is made. In this case, N equal to 4, period is 1 week. 4 week low.
Yes, sir.
We need to have a 4 week low before I become bearish. So what is the 4 week low? 1, 2, 3, here. 4 week low is here? Yes or no? 4 week low is here, visually?
One of the left is lower.
No, but that's not 4 weeks. No, that's 5 weeks. I am in this week right now, so I don't count the current week. That is the better way to do it. I look at the last 4 completed weeks. So right now my boundaries were actually 2281 and 1 previous week, week before that, and the week before that, last 4 weeks only. You are right that from a plain high-low perspective, there are lower lows before that. Okay, but we are using the Donchian system right now. So we are locked into the Donchian system, which tells us to only look at 4 week highs and lows. Are you following why I'm not going beyond that? Only 4 weeks. 4 weeks high and lows. Okay, so 1, 2, 3, 4. So the 4 week low is over here. Okay, so right now I have gone long at 2281.25 and my stop is at this level. 2103.30 means stop will be 2103.25 point. How did it get 30? Maybe it's 5 paisa. So it's not 25 paisa, it's 5 paisa. So 2103.25 will be my stop trigger level. Are you following? Is everyone following this? I hope everybody's following the logic here. Yes. Stop will be 2103.25. Clear? Okay, so this is mine. Now obviously, now suppose the market actually shoots up and breaks above 2300 and keeps on going for 5, 6, 7, 8 weeks. Then when I'm 9 weeks away from today in the future, okay, then obviously this is not my stop. I will have to recalibrate that stop by doing this exercise once again. So it's a running process, okay. So once it goes forward, you have to always look back 4 weeks and find out what is your high and low that you have. Is this clear? Is everyone following so far? Okay. Yes, Parul, clear? Logic is clear? You'll have to keep on moving it because it's any time the 4 week high and low at any point of time, the previous 4 weeks high and low. Alright? So you don't get stuck over here as the market moves and time elapses, you have to keep moving forward. Okay, so you can see how simple it is. Okay, now let's look at the other aspect. Okay, before we go to that, let me just quickly do this other part, which is the mean reversion part, okay? Which is mean reversion essentially. What have I written here for momentum traders? A meter. So we'll just define mean reversion here. This is also still in your notes. Okay, mean reversion traders, okay, what will they do? Okay, so has ended is a little bit stronger. Okay, so let me put that in bracket. Will reverse is a slightly weaker kind of view. Okay, but essentially what a mean reversion trader does is, probably we'll find that Chug is a mean reversion trader. So he will look at this kind of a chart and he will say, oh, it's gone up a lot, and a lot of people do that actually. I think it's possible that the majority of traders are mean reversion. I haven't done a survey. It's a useful thing to do maybe for some of your research projects. Okay, find out how many of your colleagues. You have to do it in a rigorous way. So essentially what a mean reversion trader does is the opposite of a momentum trader. The first category of momentum trader is a purer form of the momentum trader, that he doesn't even need a confirmation. Okay, he just assumes that the current trend is, because I don't see any sign of a reversal, since I'm not seeing any sign of a reversal, therefore I assume that the trend is still continuing, because the trend will continue until it ends, and it has not ended. I don't see any sign of it having ended, right? So therefore trend will continue until it ends, so it will continue. I just assume it's continuing and I buy straight away. Okay, but the mean reversion trader is the opposite. He looks at any long-term trend or even a short-term trend. He always assumes that the current trend will reverse. So that's why I'm writing your definition, that current trend will reverse. Okay, slightly weaker statement than saying has ended. Okay, so if you're a very strong mean reversion trader, then let's say you can think of it as you have a strong view. The main point about a mean reversion trader is that they suspect the current trend. They are skeptical about the current trend. Unlike the momentum trader, who is very happy to jump onto the current trend. He just assumes that the current trend is going to continue. The mean reversion trader is the opposite. He looks at it and says, oh my God, it's gone up so much, I think it's going to reverse now. Okay, which you would have been I think you're very familiar with this kind of thinking. Maybe you have seen many people who have this kind of approach. Yes. Okay, so therefore that's the idea behind mean reversion. Okay, why is it called mean reversion? Understand this. Okay, that if you look at this chart, what do you think is the mean price here? Just take arithmetic mean. What do you think is the mean price over here? Roughly somewhere probably around here, something like that.
Yes.
Say it's around 1107 or something like that. Okay. So now think about this. If this trend reverses in a big way, okay, then is it going to come closer to 2250 or is it going to come closer to 1107?
1107.
It will tend to come closer to 1107 if it reverses in a big way, this trend, right? Okay, so now you understand mean. So we already identified the mean on this chart. Okay, so the mean is around here, let's say, and you understand the word reversion. Reversion, somebody calls you, says I will revert later. Okay, that means I will get back to you later. So reversion has the idea of going back. Okay, so therefore the reversion is, if we say mean reversion means, actually what it means is, actually what we intend to say there is reversion to the mean. What we really want to say is reversion to the mean, but we use the short form and say mean reversion. Okay, what we really mean is reversion to the, so a mean reversion trader is always mentally projecting a reversion to the mean. And so obviously you can look at the definition from another approach now, which is to say that, okay, you have 1107, let's say, is the mean actually, and if you are going to have a reversion to the mean on this chart, then that can only be achieved by reversing the current trend, by neutralizing this current trend. If we are going to have a reversion to the mean, if the market has to come back to this 1207, okay, all right, then in that case obviously it has to break this current trend, because you can see this this low will be broken. Okay, so it will substantially reverse this trend. It will neutralize this uptrend. Okay, so basically the mean reversion trader always thinks like this, that he looks at the current trend and thinks that it's going to turn around. Okay, it's going to revert. That's why we call it a mean reversion approach. Okay, and the other name for that is a contrarian approach. A contrarian is somebody who thinks differently from the majority. Okay, and the market is taken as the majority. Okay, so the market is basically, obviously the majority is pushing prices higher. That's why the market is going up in this case. Is this clear? Okay, so the contrarian is the other name for this. So the opposites of trend following is contrarian. Okay, which you'll find many people who are basically will look at this and say it's going to reverse now and the market is overvalued and this and that. Okay, which by the way is not a correct way of using. Overvalued is not the correct statement, which you will be when we study value versus price. When people say, have you heard this expression, the market is overvalued? Have you heard this expression? If you're listening to, that means you're not listening to enough business television. Yeah? You heard the expression, market is overvalued. In business television, every day somebody will come up and say, the market is overvalued. Market is overvalued. Okay? Actually what they mean is, the market price is too high relative to my assessment of fair value. Because market is overvalued is not correct. The market always prices, the market does not value. Okay, because the market price is objective. Okay, so value is subjective. And what the guy who's saying TCS is overvalued at 2247, he probably thinks that the fair value of TCS is something like 1600. Okay, according to him. But fair value is a subjective concept. All this NPV stuff that you do, IRR, is all subjective because it's based on projections of cash flows, which are all basically up in the air. I mean, you will have one projection, she will have some other projection. Okay, and there's no way to prove that you are right and she's wrong until now 20 years have gone past in the future, right? Is this clear? Okay, so it's all subjective. Value is all subjective. All that stock valuation, all that stuff you've learned, dividend, current growth model and all that stuff, it's all subjective. The value of the stock that you get from that is all subjective. Okay, it's fair value, it's all subjective. So when a person says the market is overvalued, what he means is, it's the market price is too high relative to my assessment of fair value. Okay, but obviously nobody is going to think about all these things. They just keep saying the market is overvalued. Okay, all right. So anyway, so mean reversion, they expect it to turn around and come back. Okay, that's what mean reversion is. Okay, all right. Okay, so let's understand the breakout trading system. So now mean reversion essentially, okay, is that it's just that there are many approaches. Most of the indicators that you see, if you're looking at technical analysis indicators, what I've shown you here on the chart school system here, you'll see chart patterns. Okay, but there are many other technical analysis approaches like moving averages. And moving averages are actually trend following, but you'll see RSIs, oscillators. Most technical indicators are actually mean reversion tools. Okay, they're tools to support mean reversion strategies. Okay, so very common, but you should understand. So you should understand momentum and mean reversion well enough so that if I give you one particular strategy and ask you to show me, to tell me whether it's a mean reversion strategy or a momentum strategy, you should be able to tell me whether it's a mean reversion or a momentum strategy. Okay, right? So, all right. So, for instance, briefly, I'll just tell you. I'll give you one example of mean reversion. Let's look at General Electric, which is a stock which is in a great deal of trouble right now because of all the allegations about accounting. Have you guys heard of all that stuff? You're not following business news. That I can see very clearly. You're not following business news. General Electric is one of the most famous companies in the world, but it has been subjected to now allegations about accounting improprieties. Okay, so now General Electric is basically down. Okay, let's assume that we don't see this. Let's say we only see this. Okay, so I'm looking at a long downtrend. Essentially, what a mean reversion trader will do, essentially will say this has got to reverse. It's fallen too much. It's got to reverse. Okay, so one most famous approach of mean reversion strategy. One most famous, have you heard of value investing? Warren Buffett does value investing. You guys are not reading enough. You're not reading enough, and you're not following the links I've given you because by this time in your second year you should have heard all these terms. Okay, you're not listening to enough business television. You're not reading enough. I've given you links to the Intelligent Investor, value investing. You should have heard of. Warren Buffett uses value investing in equities. Okay, and there's another famous investor called Howard Marks who uses value investing in debt. Normally, when the market uses the word value investing, they're always referring to equities, but there's nothing really that confines it to equities. You can do value investing in debt also, which is what somebody like Howard Marks does. Howard Marks has a website called Oak Tree Capital. You can go to that website and it's not Oak Tree. Howard Marks. Go and read his memos. Okay, Howard Marks memos. Search for his memos, you'll see them. A lot of good commentary on the markets. As a finance student, you have to do all these things which I'm telling you to do. Otherwise, your education is not complete. Just studying the syllabus is not good enough because the material is so vast, we don't have time to cover it in 3 courses. You have to follow my instructions and do it on your own, beyond your curriculum. Okay? So there's a link right there. Okay? So value investing, essentially, another term that you should have learned. Okay, so value investing, Warren Buffett, you'll find this in that book I've given you, Intelligent Investor, Buffett. Okay, just go to YouTube and you can look for a lot of lectures on Buffett on value investing. Okay, so the point of the value investing approach is, okay, that here, so the guy will look at GE, Buffett. I don't know whether he's actually bullish on GE, but I'm just giving you a contrived example. So he'll look at GE and say that my estimate based on my projection of the cash flows for GE, okay, what will be the earnings of GE in the future periods, just like using your stock valuation model, typically a Gordon growth model, and whether you use dividends or earnings doesn't matter, because eventually the last period earnings has to be given out as a dividend, okay, if you're closing the company. So it's either, doesn't matter what you use. I prefer to use earnings. So he does the earnings projections and he finds that, discounts it at the cost of equity, finds that the fair value of the stock of GE is probably $28. Okay, so therefore he says that this is too low and I'm going to buy it here because the fair value is $28 and the market is much below the fair value. So therefore this will eventually have, one of the assumptions he's making is that the market will eventually have to return to fair value. Okay, this is what a value investment. So in a very short, in a very brief way, you have already learned what value investing is. That's what they do. You already know these models from your FM1 and FM2. Okay, that's all they're using. Okay, the problem there is the projection of the cash flows. Even Warren Buffett's projections could be wrong. As we saw that in the case of Heinz, he miscalculated the value of Heinz. There was a massive write down in Heinz. Okay, he admitted also. You can Google for Buffett and Heinz as well. Okay, you can YouTube, check on YouTube for Buffett and Heinz. He admits that there's a mistake. So basically what he'll do is he'll assume the fair value is $28. Market is here, so he'll buy it. Because eventually he's assuming that that's what all value investing assumes, that the market will eventually return to fair value. Okay, that is to my estimate of fair value. to Buffett's estimate of fair value. Okay, whoever is the investor, his estimate of fair value. Okay, that the market will return there. And so, can you see that this is a mean reversion strategy? Because if the market is going to return to this in this kind of a situation, if it's going to return to this, is it going to be reverting to the mean or not?
Yes.
It has to be reverting to the mean. The mean may be a little lower, but it will go through the mean, right? So that's why value investing is a mean reversion strategy. It's not a momentum strategy. Are you following? So this is the first thing you have to learn, that between value investing and so to understand momentum and mean reversion, you can see that value. So you should be able to understand it well enough to see when you are presented with a particular strategy, you should be able to understand that this is a momentum strategy or a mean reversion strategy. So now you've learned a little bit about value investing also, and you got to read a little bit more. Okay, and then you can see that it's a mean reversion strategy. The Donchian system is an example of the momentum strategy because it goes with the trend. Okay, all right. Okay, that is, we are assuming that you are applying the Donchian strategy without, basically at this point in the Donchian strategy, you would not be. We have one more thing to cover about Donchian. It's 45. I'll just take 5 minutes of your time. No, I will have to take, because we are running out of time now. 1 minute. This is your lunch time. Don't worry. Yeah, but you have 45 minutes. I'll just take 5 minutes. 1 minute. 1 second. Okay. Are you following so far? One quick. Okay. Now you follow it. You do this on your own later on. What decisions? So far it's clear. Momentum, mean reversion. Donchian system, you understood. Enter at 4-week high, exit at 4-week low. Okay, here we are going with a one-sided approach. That is, we are not exiting at the 4-week low and going short. Okay, I'm giving you a sort of a non-stop and reverse version of the Donchian system. So what are the decision problems solved by the Donchian system? We'll just do this quickly and we'll end it here. Okay, it is in your notes, so you don't know. What are the decision problems? What are our decision problems? Market, asset class, and market instrument, asset class. That is fine. That's solved by the investor. After that, we have the buy-sell problem. So Aurora was asking me, why did you decide to buy and instead of deciding to sell? Okay. So can you see that the Donchian also solves the buy-sell problem?
Yes, sir.
If you don't have a view on the market and you just go with the Donchian system, can you see that the Donchian is also solving your buy-sell problem in the first place?
Yes.
The most fundamental buy-sell, one of the most fundamental problems that people worry about.
Yes.
Is it clear? It is already solving your buy-sell problem in the first place by telling you that 4-week high you buy, 4-week low you sell. Okay, so it is solving the buy-sell problem. What is the other problem that it is solving? Entry price. Normally we scratch our heads on the entry price. So should I buy at market? Should I place a limit order? Should I try to buy at a little less more favorable than the market? Are you following?
Yes, sir.
It is also solving your entry price problem. Can you see that?
Yes, sir.
Because it is making you enter at a stop order with using a stop order. So it's solving your entry price problem also.
Yes, sir.
Okay. Anything else it is solving? Exit price. Good. Now there is the only thing of exit. How to exit? Okay. Exit price. Any other problem that is solving? Yeah, pretty much it. Basically, it takes care of all your problems, because essentially you don't have the take profit problem. But as far as the problems that are solved are these 3 problems. It is solving these 3 problems for you. You still have to solve the other problems. Position sizing, amount, that is not solved by this. That comes from your risk management system. Is this clear? Okay. So I've taken only 3 minutes. Why you guys are crying so much? Sukriti has also joined Garvit's team of monitoring the class termination. Okay. So did you